Greetings, members one and all of the Salivation Nation. Quantitative easing not just from the Fed, but also the U.S. Treasury in 2021. Let's explore. Yes, this article comes to us from Zero Hedge and was shared with me by Steve Gerard, and very interesting indeed. This is something that really should not surprise most of us and give us all the more reason why we should hold on to our gold and silver for sure, because it's coming from all directions, it seems. From the what we saw with the repurchase agreements that was happening really since mid to late last year in 2019. It's continuing in record numbers from both Congress and the Federal Reserve, and now the U.S. Treasury will unleash $1.3 trillion in liquidity, according to this article here, as authored by the pseudonym Tyler Durden. As we get into this, I want to encourage you to hit the like button and hit the bell for notifications for any new videos that will come, and subscribe as well. Know that I post videos on a daily basis, and so I very much appreciate the support. One of the most poignant and painful to some lessons in the past decade, especially to the contrarian bearish investors such as O'Day and Horseman, is that the Fed can keep printing money far longer than any short can remain solvent. And while it was considered in poor taste until earlier this year to admit that the market levitation is entirely due to the Fed's manipulation of markets, a task best left to fringe tinfoil-wearing blogs, all pretense disappeared after Jerome Powell nationalized the bond market in March. And just last week, Morgan Stanley's chief rate strategist, Matthew Hornbach, admitted that central bank liquidity is the most critical component of rising macro markets. It both greases the wheels of transactional finance and changes the opportunity set available to investors. It's also why Morgan Stanley has been especially bullish on markets in 2021. As Hornbach summarized it simply, when it comes to liquidity, our focus is on both narrow and broad measures. We expect both types of liquidity to expand in 2021. Last Monday, it was discussed earlier, namely that provided by central banks, the first type of liquidity, or narrow. The math was, in a word, staggering. Combined with the 8 DM central banks are expected to purchase U.S. $304 billion of securities, $238 billion of which will be government bonds, on average from private markets every month in 2021, with the Fed and the European Central Bank naturally doing most of the buying. That's right. This is why we think the stock market basically, essentially, is propped up by this quantitative easing. Much of it happened in the previous presidential administration. Here we can see in these graphs that show here the G10 central bank expected average monthly QE pace in 2021. And Bank of China, Fed, European Central Bank, and others down the line here. And this bar chart shows that the G10 central bank expected average monthly QE pace in 2021. Here we see where the European Central Bank is only a few bits behind the Federal Reserve here. Going back here, if we look at it in context, a total of 8 central banks are expected to add liquidity worth 0.7% of the annual nominal GDP on average every month in 2021. That is a rapid pace of global liquidity injection, the likes of which we haven't seen outside of 2020, Hornbach casually inserts. What is even more striking is that this may not be enough. After the Fed monetized virtually every dollar of net Treasury issuance in 2020. In 2021, Treasury supply will significantly outstrip Fed purchases. This is even without factoring in the possibility of another major fiscal stimulus. Now keep in mind that was talk about the Treasury may take over the Fed. Talked about that, how that might be a good thing for a second Trump administration. Said otherwise, while the Treasury faces net Treasury issuance of roughly $2.4 trillion, the Fed is expected to monetize less than half of this total, or $960 billion. Considering that in 2020, under the auspices of helicopter money, from which we remained readers here, is no simple coming back, the Fed will have monetized virtually every dollar of net issuance. That is a huge cliff, and one that could lead to a shock drop in Treasury prices if the market reprices its expectations for Fed monetizations. In other words, the Fed needs to more than double its scheduled monthly QE in 2021 just to catch up to where it was in 2020. And the Fed is hardly alone. In just the past month, the RBA, the Bank of England, and most recently the Reichsbank all announced expansions to their current quantitative easing. Everybody's doing it. And here comes a twist, because in what may come as a surprise to some, in 2021, liquidity injections won't be limited to quantitative easing. And that doesn't surprise us, as we saw the repurchase agreements, which was covered on this channel pretty extensively when that occurred. And it talks about here, as traders who lived through the reserve squeeze of September 2019 recall all too vividly, central bank purchases of securities via QE aren't the only way liquidity can find its way into markets. The U.S., the Treasury can increase liquidity by allowing its cash balances held at the Federal Reserve to decline. When Treasury issues debt, it can either spend the money on government mandates, or it can keep the money in its checking account at the Fed, known as a Treasury General Account. To be sure, from a liquidity perspective, Treasury debt issuance on the subsequent spending does not impact liquidity on net. In general, when Treasury issues debt, banking system reserves decrease. And when Treasury spends the money, banking system reserves increase. So as Hornbach reminds us, 2020 was unique in that the Treasury issued a lot of debt without spending the money, resulting in over $1.6 trillion in Treasury cash available for deployment at a moment's notice. Yet due to Congress's inability to reach agreement on a fiscal stimulus, this money was never spent and may have cost Trump a victory in the election. Here's the Treasury cash balance. We can see here how it has just spiked up here towards the last quarter of 2020 here, or last half of 2020. As a result, the cash balances in the TGA increased dramatically, resulting in a massive liquidity drain. In fact, were it not for other sources of liquidity injection, such as Fed injecting hundreds of billions of monthly periodically, that may have been a huge problem for markets. In any event, as the chart below shows, despite the Treasury's liquidity drain, reserves increased in 2020 regardless, surpassing a record $5 trillion. Wow. All this money spent, it's crazy, or being held out there. And I think this is part of the reason why we haven't seen the massive inflation that everybody fears is coming. So what happens in 2021 with all the cash already sloshing around? As Hornbach writes, in 2021, the Treasury General Account will experience more volatility due to the debt ceiling deadline, but will initially result in a very large injection of liquidity. The debt ceiling deadline is August the 1st, 2021. On this date, the U.S. Treasury will not be able to issue any additional debt above that and beyond what it needs to cover existing debt obligations. However, what few may be aware of is that there is a clause written in the law that prohibits the TGA from rising above levels prior to the debt ceiling deadline, which was in 2019. That means based off the 2019 debt ceiling, the Treasury cash will need to be $200 billion by August 1st, 2021. As such, there will be significant T-bill paydowns in 2021 through August in order for the Treasury to reduce its cash balance, leading to massive increase in reserves, which is entirely part of those injected via Fed quantitative easing, which continues at a pace of $120 billion per month, with the TGA cash currently at just under $1.5 trillion. It means that the U.S. Treasury will unlock $1.3 trillion in liquidity over the next 8 months from the Treasury. Interesting how could work out here. More than doubling the liquidity coming from the Fed over the same time period, which will be roughly $1 trillion, which is over 8 months, 120 million over 8 months. So U.S. Treasury general account balance and Morgan Stanley projection for 2021. Wow. We hope this massive liquidity injection explains why Biden was so interested in getting a former Fed chair, Janet Yellen, in charge of the Treasury. After all, the amount of liquidity to be injected by the Treasury Department will match almost dollar for dollar what Jerome Powell will do in 2021. So when will this liquidity impact markets? The Fed first announced its QE-driven foray into liquidity provision on Sunday, March 15th, and as Morgan Stanley notes, it took a couple of weeks for the liquidity flow to where it was needed most. The S&P 500 bottomed, and the Fed's broad trade weighted U.S. dollar index topped on March 23rd. Since then, the U.S. dollar index has lost 9.4%, and the S&P index is up 60%. In addition, U.S. 10-year real yields have fallen 100 BP, while 10-year break-even inflation rates have risen 100 BP. In that sense, the injection of liquidity in 2020 has already had an immense impact on markets. So how do we know markets will feel the impact again in 2021? In the end, liquidity doesn't have to find its way around markets if it doesn't have an incentive. And it certainly doesn't have to find its way into risky assets. As we saw ahead of the U.S. election, $1 trillion found its way into money market funds, given the uncertainty of a well-telegraphed risk event. However, according to Hornbach, in 2021, the sheer size of liquidity entering markets will make it hard for investors to keep it sitting in cash accounts, earning next to nothing. And given virtual guarantees and most central bank policy rates will remain at effective lower bounds in 2021, and many will remain there in 2022 as well, Hornbach concludes that investors will have an incentive to move cash into higher yielding assets. In the end, it's not possible for us to say exactly when the liquidity will impact market prices throughout the year. Still, once the race for returns begins as we enter into the new calendar year, the new fiscal year for many investors, we expect liquidity to venture out of its safe haven cash cave, just as long as new unforeseen uncertainties aren't mounting up at the same time. In other words, buy everything ahead of the unprecedented dollar devaluation orgy. And there are a lot of things have got to happen here, and the timing has got to be as such that really they can't tell what's going to be. But it's very interesting the things that are here, and the sloshing around these accounts is telling us something. All this money and how the Treasury will be kind of the de facto quantitative easing engine that drives liquidity. And they're kind of forcing their hand in that regard based off of what we've learned here in this article. But there's probably a lot of other things that are behind the scenes that maybe this article doesn't take into account that may save some of this off. But the lesson here is all the same. Liquidity, no matter where it comes from, the Fed or the Treasury or Congress or both or all three, both narrow and broad measures, means one thing: the dollar will depreciate in its purchasing power, as it has done and will continue to do. It just may be speeding up quicker than we think, or in some cases it may be staved off for a bit, depending on what they can do and what levers they can pull behind the scenes. Because as you can see from this article, there are a lot of levers that are being toggled and tweaked, and they're not necessarily bound really by anything. They can do what they want. They may have to do this or do that because of these things and be triggered out because of this or whatever, but they can find ways to trick it and to pull levers to make it do whatever they want and release it how they want, when they want. But nonetheless, one thing they can't pull a lever on, and that is gold and silver, which is why it's always wise to have some of that in your possession, because it cannot be manipulated, it cannot be tracked, it cannot be twisted, bastardized. The price may go up or down, and it does, and it will continue to do so, but the value will remain the same. So there you go. Very interesting indeed. Hope you found this video helpful and useful. And I'd like to thank again Steve Gerard for sending it along to me. I'd like to extend a multitude of gratitude to you all for taking the time to watch this video, and encourage you to please rate, share, comment, and subscribe.